Hey friends, Josh Yeager, fiduciary governance big wheel and Santa Barbara dog walker. I'm out on a stroll with my dog Dodger. There's Dodger checking out the landscape. And I thought I would bring to your attention a risk that I am a little bit anxious about for trustees. We're at the beginning of 2023. And we all know that the performance of the capital markets in 2022 wasn't great. The S&P 500 was down about 20%. The Barclays Aggregate Bond Index was down about 10%. So if the trustee had a portfolio of, let's say, 50% in stock and 50% in bonds of a liquid portfolio, they're probably down 15% for 2023. Now, that's not that big a deal, right? We know that the performance of marketable securities is highly variable. There's standard deviation, bouncing them around. Sometimes they're great, like in 2021. Sometimes they're bad, like in 2022. But when you're a trustee, and there are beneficiaries who are already predisposed to misjudge your efficacy in that office, they are going to use the bad performance of 2022 as an opportunity to sue trustees. This happened in the dot-com crash in the 2000s. There was a spate of trustee breach suits following that period of time. It happened after the financial crisis of 2008. A whole bunch of trustee breach arguments by ticked off beneficiaries. The complaint's pretty much the same. These all look the same. They say the trustee breached their duty to prudently monitor the activities of the investment advisor. Trustee failed to diversify the portfolio sufficiently. Trustee failed to establish return objectives and risk expectations that were consistent with the trust purpose. In short, the trustee's a knucklehead. So that complaint happens almost every time there is a period of bad performance generally in the capital markets, and ticked off beneficiaries want to get the trustee removed and replaced with somebody more friendly to their interests, or themselves in many cases, or they want the trustee to increase the distribution rate to them, or whatever. They want to rattle the trustee's cage. So none of this means that the trustee has done a bad job. Just because the beneficiary has made this argument doesn't mean it's true. But I think it would be a good practice for trustees that A, know they have disgruntled beneficiaries who can never be made happy, and B, know that the performance of the liquid portion of the trust assets was less than target, let's say, in 2022. The trustee would do the following things. Number one, they would ask the investment advisor to run an analysis of how often this portfolio with this allocation and this design had this magnitude of drop. Because we want to have something in the file that says, hey, the trustee knows that there was a bad outcome last year, and we want to create a record that the trustee was thoughtful and looked into whether this was a normal thing that happened or an abnormal thing. Other things that the trustee may do is ask the investment advisor for any recommendations that they have, the investment advisor, whether changes in the portfolio are appropriate in the upcoming year. My hope and expectation is that the investment advisor says, no changes, portfolio is a good portfolio, it just doesn't always perform well. So my hope is that a professional advisor will have that kind of response rather than, oh yeah, we're going to add a whole bunch of new things to the portfolio and change a bunch of stuff. But being proactive as a trustee and asking for that record would be helpful. Reaffirming the target rate of return and expected risk is a good idea. Now that should be done every year, but in a year where there was particularly bad performance in the prior year, and where the trustee has some appropriate anxiety about the litigious nature of the beneficiaries they serve, trustee would also do that exercise and just meet with the advisor and say, hey, remember, this is a trust. I need to write down what the target rate of return is. I need to write down the expected amount of volatility and risk. Establish that what we experienced in 2022 was within those expectation bands. Though frustrating, it's what we signed up for. So going through that exercise would be good. Last thing, if a trustee wants to avail themselves of an independent manager review, that might be a good thing. That's having a third party that doesn't have a horse in the race review the manager's portfolio and performance and fees and allocation, etc., and opine upon whether it's the current allocation and the current manager's activities are reasonable in light of the trust purposes, etc. Now you got to be careful when doing this. Obviously, if you're working with the guys at Merrill Lynch and you go over to the guys at JP Morgan to do the independent portfolio review, I can pretty much assure you what the findings will be, because competitor investment advisory firms or platforms aren't truly independent, right? Because they'd like to convince the trustee that the current investment advisors are knuckleheads and that their platform is much better. So a truly independent advisor, independent review of the incumbent advisor would include a prohibition from the person doing the review from ever being the advisor, right? That kind of stands to reason. So those are a couple tips and tricks, and it all stands ready, willing, and able to do these independent investment advisory reviews. If there are any trustees that are anxious about having some supporting data in their file, particularly in lieu of the less than optimal performance of the investment industrial complex last year. Hey, Dodger, we're going this way, bub. Dodger, this way. Look at that dog go. Woo! And so I think that about ends the video for today. Thanks, folks. Ciao.